Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Christopher Aaron, founder of iGold Advisor and senior editor over at the Gold Eagle website. We're going to be talking about gold and its breakout, something that a lot of us have been waiting for. And Christopher, I do have to give you credit that it was months ago that you even outlined the scenario where gold and the US equity markets this year could be making all-time highs. We're in March and we already have that. Gold finally at all-time highs and US equity markets continuing at all-time highs. Let's focus on this breakout in gold though. The big question everybody has is this going to reverse quickly, or is there more legs here? Is this run higher in gold just going to continue?
Yeah, thanks, Corey and Shad, for having me back on the show, and thanks for bringing up that point. We did outline a few months ago that both the gold chart and general equity market charts, whether we're talking Dow or S&P 500, they were both bullish independently. Both of the patterns were bullish and suggesting there would be upside breakouts. So now we've seen those upside breakouts in both markets here over the last week for gold, and then getting back into the earlier part of the year for general equity markets. And so it's just important to really step back and think about that. I mean, it's like, wow, the 5,000-year-old store of wealth is at a new all-time high for the history of human civilization, and industrial and technology stocks are also at all-time highs for the history of, the United States. It's like, what is happening here? And so I think it's important to acknowledge this, and then to also therefore acknowledge that the ratio between these two asset classes that we've been studying very closely over the last number of years, the Dow to gold ratio, has therefore not broken out. When we have both components of the Dow to gold having broken higher, it means that the ratio between those things continues to move sideways. And so we have to analyze each market independently, and then we have to do the ratio analysis. And what it's telling me is that both markets are going to have significant new highs coming, new waves higher coming here over the next 2 to 3 years. At some point in this cycle, within the next 2 to 3 years, we will get a signal on that Dow to gold, and it will tell us which one of these breakouts, stocks or gold, is the legitimate one, and which one is going to top out and enter some sort of bear market, perhaps for a couple of decades after that. We're not at that point. Both are breaking out now, and we have good waves higher here coming for both markets. Let's focus on gold itself, and let's talk about the expected pathway higher for gold. This leg higher, I mean, we're only 5 days into the breakout. The previous daily high close was set 4 years ago, we're talking about, and so we're only 4 trading days now above that previous all-time high. Getting the second weekly close here tomorrow on Friday, March 8th, will be a very good signal that this breakout is legitimate. Gold has a rather reliable pattern that it makes after we break former all-time highs in these multi-year consolidations. When we look back at both the 2008 to 2009 breakout, and also when we look at the 74 through 78 breakout, gold tends to have an initial run following the breakout, which is what we're seeing right now. Gold's currently trading at 2160 in the spot market as we're speaking. Gold tends to have this initial thrust higher, and then over the course of the next 2 to 4 months, it tends to retrace the entirety of the breakout from that breakout point, which in this case was 2075, and it tends to come back and retest the breakout point. And this is sort of a functional way of the market saying, and of course we're talking the sum of human participants that are involved in gold, really they're saying, hey, is this breakout for real? So don't just hold it for a day or two or a week or two, but actually if those initial profit takers come in and start selling here over the next couple of weeks, do the buyers have the resolve to step in again at 2075 does that level now turn to support? In both the previous instances we talked about in 2009 and also back in 1978, in both instances, resistance did turn to support. And after the retest, gold should then be expected to power higher for a window of about 2 to 3 years after the breakout point. So that's what I'm looking at here over the next 2 to 4 months. And then after we get that retest, I'm looking at a nice 2 to 3 year trending move higher setting up for gold.
Well, Christopher, I'm sure a lot of people listening will be happy to hear that, because what we've been seeing for the last few years is only a 2 or 3 month move higher, not a 2 or 3 year move higher. And so it'll be nice to see a little bit of action stay in the sector as far as positive upward direction after we get that first initial retest that you just outlined. But I'm sure people are thinking, how high does it go? What's the path forward? You've outlined in a previous show that you saw this rectangular consolidation over the last 4 years, and you expect that to extrapolate forward. But for people that missed that, maybe outline where you think the pricing move is going in the next couple of years.
Yeah, so these rectangular consolidations that we've been in here for golds over the last 4 years, they have a fairly reliable way to measure a target calculation. And what we do is we look at the widest amplitude of the consolidation that gold has been in here underneath that key 2075 level for the last 4 years. The widest part of the consolidation was, again, from 2075, the resistance, down to 1,615, which were the lows for that little false breakdown that gold had in late 2022, October of 22. That amplitude is $460. So from the lows of the false breakdown to that amplitude, we have $460. And you have to think about what happened in that consolidation here over the last 4 years in that $460 amplitude. There were buyers, there were sellers, there were speculators, there were hedgers, producing gold companies coming in that were selling forward their production, that were thinking, hey, we're going to be in this sort of consolidation forever. Therefore, I want to lock in, or maybe this is going to represent a final top. Therefore, I want to lock in the current price of gold. Maybe we're at 18 or 1900. Let's lock that in by hedging forward our production. Now that we are at new all-time highs, all of those producers, all of the short sellers, all of the speculators that were thinking gold was going to top out here, they are all wrong on their forecasts. And they are now all incentivized to cover those shorts, to cover those hedge books, to cover those protective positions. And they'll do so sequentially as the gold price starts marching its way higher. And so we have that $460 amplitude, and we're going to, roughly speaking, have a fairly reliable target of that same amplitude being covered onto the breakout point. Of course, we're also going to have FOMO people coming in at the end of that move. We're going to have some new buyers eventually who are attracted to the headlines of record high gold prices. But that said, we have an official target now of 460 added onto the breakout point, which is 2,535. That's my official target until proven otherwise. It would take weekly closes back below the breakout point to negate this target. I don't think it's going to happen. I just want to mention that for disclaimer purposes. But this looks to be a legitimate breakout on our hands. So 2,500 plus or minus a few dollars. I should say as a final point that these official target calculations are my highest expectation. It's always possible that a market undershoots, some black swan event comes in there, the market undershoots the target, but it's also possible that a market simply pauses at the target and then continues higher after the target is met. Just because we have an official target, yes, it's a highest probability. It's where I would want to put the majority of my chips. But then once the target is achieved, we take a step back and we say, hey, could there be another leg higher even after that?
Let's talk about the underlying equities then. And I want you to more look back in history and just outline when, if ever, we have seen a scenario here where gold prices are breaking out. 2 all-time highs, and the equities have been in downtrends, multi-year downtrends. And when you consider the highs of something like GDX from back in 2011, it's now half of that level. Have we seen this drastic underperformance of the stocks in an environment where gold is breaking out before?
Yeah, actually, we have. We've seen it on several really important occasions. If we look back to the 2007 to 2011 cycle, gold finally broke out above $1,000 per ounce for good in October of 2009. It had been consolidating between roughly 700 and 1,000 for the previous 2 years, below that 1,000 figure. Gold finally broke out in October of 2009, and it went up to 1225. That's an 18% move in 9 weeks. By the way, in today's dollars, that would be equivalent to a $400 move in 9 weeks. So that would be like gold basically achieving my $2,500 target in 9 weeks. Forget about 2 to 3 years, but I'm just putting it in perspective for what happened back in 2009 in percentage terms. Now, the key thing is that after that initial thrust up, gold did not continue powering higher all the way to 1900 in 2011. It first stopped, retraced the breakout completely, and by February of 2010 came all the way back to retest the breakout point at $1,000 per ounce. That retest was successful. It held. And from there, over the next 2 years, gold went from 1,000 to over 1,900. However, it's very important to remember that when we look at how the miners performed in that sort of breakout and retest scenario, the miners actually made a lower low on the retest of 1,000 than where they were trading when gold actually broke out above 1,000. And that's because, the miners are a group of investors who are watching the gold price very closely. We're talking the sum of mining participants. And mining investors, we've seen this a number of times, they often get it wrong at the very end of a critical point in the markets. The sum of the mining investors get impatient. If we see as a net sum, let's say gold break out and then come back and retest that point, the sum of the mining investors can get most frustrated at exactly the wrong point, because right at that retest, so I want to let people know that there may be a final buying opportunity here within the next 2 to 4 months on a lot of these miners. From that point, that low should be a major multi-year low, following which we should see a trending move higher finally in this sector, lasting for another 2 to 3 years. So it's really critical for investors to be monitoring and to remember the lessons from history and not throw in a towel at the exact wrong moment, which is going to be the retest of this breakout.
Christopher, I think that is such an important message for listeners to hear, because human nature and emotions are, if this thing does get a retest, people think, oh gosh, I knew it. This thing's pulling back. I'm out of here. And they may be getting out at exactly the wrong time when they should actually be pressing their bets. You'd also made the point in a prior show that the 1970s were a similar kind of time period where you had the mining stocks kind of stagnant from 74 to 78, even when the gold price was doing well and the silver price was doing well. And then at the very end, from 78 to 80, that's when you saw the big uplift. And you had highlighted both Hecla and Newmont as stocks that had just blasted higher by 3x, 4x at the very end. Do you still think we'll see that same kind of pattern where maybe the mining stocks take a while to get the memo, but then at the very end is where you see those life-changing gains?
I really do. The message of bull markets, and look, we're still in a bull market for gold. We have gold breaking out to new all-time highs just here over the last week. When something is breaking out to new all-time highs, that's a bull market, okay? So gold is in a bull market. Yet the sentiment is still so subdued in this sector across so many different metrics that we've talked about, whether we look at outflows from the gold ETFs despite the breakout, when we look at subscriber and readership interest across a lot of the articles that we're looking at. When we look at trends in Google searches for people who are interested in learning about the gold price, everything is still way down in interest, yet gold is in a bull market, and a bull market which is breaking out. So it's really important to remember that bull markets don't end on pessimism. We're in a bull market, yet there's pessimism in the sector right now. Bull markets end with euphoria. They always do. They end when everyone is jumping over themselves to get on this show, to listen to this show, when you guys have so many listeners that the servers crash, right? When when people are buying gold and silver from the coin shops, and SD Bullion and JM Bullion and a lot of these APMEX dealerships are sold out and you can't get product for 2 months, that's a sign of a top. Right now, we're not in a top. Right now, we're in the warm-up stage for what could be a dramatic final wave in this bull market. And so, yes, we talked about the example from the mining sector in the 70s. Hecla, I think, is the best example. You talk about silver. Silver was flat from 1974 to 1978. It moved sideways. It consolidated below $6 per ounce for 4 years. The value of Hecla as silver consolidated was down 85%, for crying out loud, 85%. This is how frustrated mining investors can get as a net sum amidst the consolidation. We've seen the exact same thing here over the last 4 years. A lot of these miners are down 70, 80, 90% with gold sideways to now breaking out. And then what happened to Hecla? In the last year, as silver finally broke above that 1974 peak, Hecla was higher by 1,000%, not 300%, 1,000%. And that basically started after the retest in gold. And then several months after the retest in gold, silver broke out. And then the miners had that move. And that final move was 15 months long. So the waiting is still happening now. We've talked about there could still be, another several months, perhaps even the majority of this calendar year could be subdued as far as the sentiment goes. And then the lessons from every cycle in history is that you don't end a bull market on pessimism. You end it on euphoria when the mainstream investor starts to come back into the sector. And that is when the miners have their final move. So you want to be positioned in any final retest that's coming here for that final move.
So patience. You're saying patience to ride out this bull market, this breakout, which undoubtedly will have corrections throughout time for all those investors, the ones that are still in the sector, that are holding on to stocks, that have rode those stocks lower. Does the strategy simply need to be almost turn away from the computer, let those corrections play out, and hold for 2, 3 more years at least?
Yes, and make sure that your position size is appropriate to allow for that level of dispassionate interest at this time, this level of waiting. Because what I've noticed is that if your position size is too high relative to your overall income or your net worth, if your position size is too high, or let's say, God forbid, you're on margin or leverage, then when these things continue to grind and test our patience, that's when you can be either tempted because of human psychology or forced because of a margin call or a debt call. You can be forced to sell your miners at exactly the wrong moment, at exactly the low. But so it's really important to keep position sizes. You want to have a position size here in this sector onto the retest in gold that allows you to keep a knowledge of excitement for what should be coming into the final wave higher in gold. It allows you to keep that feeling of the possibility of changing your outlook on life, but not so high that you are tempted to hit the sell button on the entire portfolio every time gold drops by $50 or $75, which, as you said, Corey, it is going to do. The volatility is going to get much higher than what we've seen over the last 4 years. So yes, investors want to have patience, but portfolio size is key for that patience.
All right, Christopher, thank you very much for your insights here on this breakout and more of a longer term look at what we've seen over history and what to expect when we do have a market like gold that is as large as gold break out in this fashion. Definitely going to be something that we can follow along with. And I know a lot of our listeners are also just going to be following along with the stocks, saying, let's get some catch up going here. Might be still a little bit of time, judging by what's happened in history, but now it sounds like it's not the time to be offloading any positions because you could miss out on a pretty major move. Christopher, thank you very much for your time. We'll chat again probably in about a month's time, hopefully continuing to follow up on this breakout and the pattern there. Again, you want to follow along with Christopher, go check out iGold Advisor, which we will link below. Thanks for your time, Christopher.
Thank you, gentlemen.